Chapter 6, I think you will find Chapter 6 to be a very enjoyable chapter. It is not going to be too difficult. You've already done the hard work. You've learned how to analyze transactions. You have learned what side they should be recorded on, the debit or the credit side, based on the account and what's happening. Now we're just going to transfer that information to an actual accounting form. The first form that we're going to be using is a journal. If you take a look at our accounting cycle here, we start with collecting and verifying source documents. We're going to be talking about that just a bit. Analyzing transactions, and then step 3 is to journalize the transactions. The journal is just it's like a diary. It's a chronological order of all of the transactions in the order in which they happened. Just FYI, I noticed that my little laser pointer wasn't showing up, so you get the handy dandy pointer finger today. So let's move on, and we're going to be focusing our attention here and then moving our attention to the journal. The accounting cycle, as we've said before, activities are performed in the accounting period that helps the business keep its records in an orderly fashion. Those are our 3 steps we're going to focus on: collect and verify source documents, analyze each transaction, and journalize each transaction. You're going to need to know those first 3 steps. The first one is analyze and, collect and verify source documents. And we're going to be using 4 common source documents. They're not the only source documents available, but they're the 4 most common. Source documents are little pieces of paper or an electronic file or anything that documents that a transaction has taken place. The first one that we're going to talk about here is, well, it says that paper evidence that transaction has occurred. The first one we're going to talk about is the invoice. The invoice is a source document that lists the quantity, description, unit price, and total cost of the items sold and shipped to a buyer. Sometimes we refer to the invoice as a bill. It's what comes with our order if we haven't paid for it. We can have a purchase invoice, which is a bill that we receive because we purchased something, or we can have a sales invoice, which is something that we're going to send to our customers, our credit customers, if they haven't paid us. The next one is a receipt. The receipt is a source document that serves as a record of cash received. If you've ever worked at a retail store, you know that they've got the little roll of white tape oftentimes in the cash register, and sometimes it'll print off and you get that tape from the cashier if you're buying something. Although it's a courtesy to your customers to give them a receipt, they may want it for their own records. That's not the receipt that we're talking about. The receipt that we're talking about is the copy of what happened on another roll of paper on the inside. Or if you've gone somewhere and they have a pad of paper or a pad and they write something down and they give you a copy, the customer a copy, that's the customer's copy, but they also keep a copy of it. And that is just evidence that the customer has given us some cash of some sort. I'm going to skip memorandum for now, and I'm going to go to check stub. A check stub is a source document that lists the same information that appears on a check and shows the balance in the checking account before and after each check is written. So every time we make a payment, it's wise to make a payment with a check as opposed to actual cash. But every time we make a payment with check, we're also going to write out what we call a check stub that tells us how much money did we write that check for, and what did we write that check for. I'm going to go back now to memorandum. Most of these are kind of just naturally happen when we're billing somebody or we've sold something. We just kind of naturally make those source documents. This memorandum is for any incident that doesn't really fit into those categories. It's a brief message written that describes a transaction that takes place within a business. Before email, people used to write memorandums, and they were just kind of an inner office note. It didn't have to look like a formal letter of any sort, but it was very similar to what we had in our emails now, just a short, brief explanation. That memorandum is now what we use to record anything that we don't have one of these for. An example of that might be if an owner makes an investment into the business. If they make an investment, we want to write it up. We want to write just owner invested $25,000 into the business from his own personal savings. And we're going to put that in the file cabinet somewhere, and we're going to use that as our proof that something happened. Here are some examples of what they might look like depending on the business. All of these things might look just a little bit different. Here's an example of an invoice. This is an invoice that was sent to Zip Delivery Service by Kelly's Office Supply. If we're Zip Delivery Service, this is a purchase invoice because we purchased some office chairs and we owe them for those office chairs. Here's an example of a receipt. We got some money from Greer's Market. We got a total of $200. They wanted a copy for their own use, but we needed one to prove that we got the money from them. Down here's that check stub. In a business checking account, you might have a check that's actually attached over here. You write out the check, rip it off, and then this is the part that stays with the business. And it says how much the check was, when it was, who we wrote it to, and why we wrote it. And then this last one here is an example of a memorandum, and it's I have contributed $25,000 from my personal savings to be deposited into the business delivery service. So it's just an indication when it happened, who did it, and how much and why they did it. The second step you've already gotten really good at, and that's analyzing each transaction. You're going to look at what happened. You're going to look at the business transaction. In a real business, you wouldn't be looking at transactions in a textbook. Rather, you'd be looking at these source documents to determine what happened. But you'd be doing the same thing. You would determine the debit and credit portions of each transaction by analyzing the source document. And that's just a repeat of what I just said, that in the real world, you're not going to have it in your textbook. You decide what accounts are affected and if they're going to be increased or decreased, and if that's going to happen on the debit or credit side. After you've collected the source documents, you've looked them over, you decided what is going to be affected, we're not going to record them in T accounts. Instead, we're going to journalize each transaction. Transactions are entered into a journal, which is that chronological record of the transactions, and the process of doing that is called journalizing. Now, before we get into actually talking about journalizing, we are going to talk just a little bit about accounting periods, and you're going to need to know the difference between these 2 years. A fiscal year is not the same as a calendar year. A calendar year, as you can imagine, is from January 1st to December 31st. A fiscal year, however, is an accounting period of 12 months, but it doesn't have to start on January 1st. Here's our definition of calendar year. Why would we use a fiscal year? Well, a fiscal year comes in handy if the business doesn't logically start its process on January 1st. A school is a good example of that. The school year starts in August. We have to purchase some supplies prior to August. We have to kind of finish up some tie some ends at the end of May. So what they do is they start their fiscal year on July 1st, so they can start ordering supplies. They'll be here in time to start the school year. We have expenses all year during the school year, and then after May, we might have a few additional expenses that we have to pay into June, but after June, we're done with the transactions for that particular year. So you'll need to know the difference between those two. You won't necessarily need to know when they're going to be applied, just know that there is a difference. Let's talk about the general journal entry. The general journal is that all-purpose journal in which all of the transactions of the business may be recorded. When you get into college accounting, which I hope all of you will take college accounting, you'll deal with different types of journals. It might be just a cash receipts journal, or a cash payments journal, or an accounts receivable journal. But with a general journal, every transaction that we do is going to be recorded in there. It's going to have a left column for recording debits and a right column for recording credits. It's going to look very similar to your T account. Here's an example of a general journal page, the start of a general journal page, and what the transaction might look like. They don't have it up here, but you'd always want to indicate the page number of the journal. If it's a business that has a lot of transactions, we might have hundreds of pages during the accounting cycle. So you want to make sure they're numbered, so we always keep them in the right order. On the first transaction of the page, you're always going to write the year on the first line. On the second line, you're going to write the month and the day of the transaction. Then, notice that we have this line right here. Right up next to the line, we're going to write the account name that is going to be debited. So you're going to have to think ahead. What are the two accounts or multiple accounts that are going to be affected? And if they are debited, we're going to list them first. So we're going to list the debited account name first. We're going to skip over post-reference for now, and we're going to record the amount of the debit on the debit side. Here's our T account. We're going to record it on the debit side. Then we're going to identify the credit. Notice that it's indented just about a ½ inch. You're going to write the name of the account that's credited, skip over post-reference, skip over the debits, and write the amount that it's credited for. The last line of this transaction is the explanation. Now we're going to simplify the explanation by simply putting the name of the source document. So we might have invoice and it might have a particular number. If we have questions about this transaction, all we have to do is go back to that source document, go to where we have it filed, get it out and take a look at it. As you've probably already figured out, I think the best way to learn how to do something is to actually get in there and do it. So your instructor should have given you a journal that looks like this. It has approximately 39 lines on it. We're going to be working through some, not all, but some of the transactions found in Chapter 6. So if you haven't already done so, turn to page 140 in your textbook and have your general journal handy. Now I'm going to be recording transactions with a pen. And that's because that's how it's supposed to be done. This is a permanent record. It's an official document, so it should be recorded in pen. However, I'm not going to require that you use pen until later on in the process. If you want to use pencil for the first few assignments so that you get a feel for how it's done, that's fine. I'm okay with that. I'll let you know if you need to use pen. So the first thing that we're going to do is we're going to include the page number. This happens to be page 1. Look in the instructions. Sometimes it'll have a different page that they're starting on. I'm going to zoom in a little bit so you can see what I'm doing. And now we're going to turn our attention to page 140. You've heard these transactions before, but now we're recording them in just a little bit different manner. On October 1st, Krista Vargas took $25,000 from personal savings and deposited that amount to open a business checking account in the name of Zip Delivery Service. And notice that they have Memorandum 1 listed there. Here's where we have to make use of the dates. First of all, it says October 1st. You're always going to use the current year. If you want to use 2017, because that's the year this has been recorded, that's fine. I also, because I tend to lose track of what years, just trust me, I get old. I tend to do this for the years 20XX, and the XX just represents the current year. In a real life situation, you would write down the year that the transaction actually happened. Remember, on our first line of the page, we put the year. The second line, we're going to put the month and the day. This was on October 1st. If we look at the transaction, Krista Vargas took $25,000 from her personal savings and deposited that amount to open a business checking account in the name of Zip Delivery Service. What two accounts are going to be affected? You should have said Cash and Bank and Krista Vargas Capital. Now think, which of those two is going to be debited? It's going to be cash in bank, because cash is going to go up on the debit side. So right next to this line over here, you're going to write cash in bank. If you want to just write cash, I'm okay with that one. You're going to follow directly across, skip over post-reference. We'll use that in Chapter 7. And we're going to write $25,000 on the debit side. Now notice the little boxes here. This box off to the right, that's for cents. Then we have our ones, our tens, our hundreds, and everything else beyond that, thousands on up, is going to be recorded over here. So if it's 25,000, I'm going to require 25 in front of the little boxes, then fill in with zeros. And you could put zeros here. I think it tends to get a little messy. So I tend to do this, so I don't get confused as to how much money I actually have in there. But you have to have something in the cents, otherwise somebody could come in and alter the books and add a few cents to it. If cash was our debit, then Krista Vargas Capital was our credit. And notice I indented about a ½ an inch. You're going to follow straight across, go over the debits, and on credits we're going to record 25,000. And on the third line we have to put our explanation. Because they gave us the source document, Memorandum 1, we can write that. You can abbreviate memorandum by just saying Memo 1. Now, the next transaction, transaction number 2, happened on October 2nd. It doesn't always happen the next day. In fact, you could have another transaction that happens on the 1st. This one happens on the 2nd. Because it's the same month and it's the same year, we don't have to repeat year, we don't have to repeat the month. We just simply put the new date, which is the 2nd. Let's read the transaction. It says, on October 2nd, Krista Vargas took 2 telephones valued at $200 each from her home and transferred them to the business as office equipment. Memorandum 2 was our source document. First thing, what are the 2 accounts that are going to be affected? The first is office equipment and the second is Krista Vargas. Which one is going to be debited? Office equipment is our asset that goes up. So you'll write office equipment right next to the line. Come across to the debits and put 400 on the debit side. Vargas Capital, indent, and record 400 on the credit side. And then we need to go back to our source document. In this case, it's Memo 2. Turn the page and let's look at transaction 3. We'll do maybe 4 or 5 transactions, and then I'm going to turn you loose to try it on your own. I find that most people kind of get the gist of it by then. Transaction 3 on October 4th. So we skipped a day. October 4th, Zip issued a check for $3,000 to buy a computer system. Well, what check did they issue? Check 101. So we're going to write October 4th. You don't have to repeat the year or the month again. What 2 accounts are going to be affected? Cash in bank and computer equipment. Which one's going to be debited? Cash is going down, so that one's credited. So computer equipment is the one that's going to be debited. It's an asset going up. So start with computer equipment. Follow it across, and we're going to write 3,000. Then cash in bank is credited for that same amount. And on line 3, we have to put the source document. In this case, they said it was check 101. You could write check stub 101, but check 101 is sufficient because the check stub number is going to match the check. Transaction number 4, at the top of page 143, on October 9th, Zip bought a used truck on account from Coast to Coast Auto for $12,000. We know that because of invoice 200. Start with your date, October 9th. The two accounts, they bought a delivery truck, so that's delivery equipment, and accounts payable, Coast to Coast Auto. Which of those two is going to be debited? We're going to increase delivery equipment by $12,000 because we've added to our delivery equipment with that truck. And it's an asset. Total $12,000. And accounts payable, Coast to Coast, accounts payable increases on the credit side, and we have just increased our debt. So you can abbreviate just a little bit, but we need to make sure that you get a clear idea as to who we owe the money to. Try not to get into this post-reference section here. And it's for the same amount, $12,000. What is our proof that this transaction happened? Well, it was invoice 200. Let's try one more. On October 11th, this is transaction 5, on October 11th, Zip sold one telephone on account to Green Company for $200. We know this because of Memorandum 3. First, we're going to record the date, and then you're going to identify your two accounts. Office equipment and accounts receivable, Green Company. Which of those two is going to be debited? Office equipment is going down, so that one's going to be credited. It's an asset that's going down on the credit side. So accounts receivable is our asset that's going to go up. And then our office equipment, we should follow through here. Accounts receivable 200. And then office equipment. $200. And we know that that took place because of Memorandum 3. I'm going to give you just an opportunity to do a couple of transactions without me. So stop the video. I want you to try transactions 6, 7, and 8 on your own. And then when we come back, I'll show the answers to you to see if you got them right. Welcome back. Check your work. Starting with October 12th, you should have accounts payable Coast to Coast Auto as a debit of $350 and cash as a credit of $350 with source document check 102. October 14th, you should have had cash with a debit of $200. Indent, accounts receivable Green Company as a credit for $200, source document receipt 1. I'll move this up just a slight bit. And on October 15th, cash was debited $1,200. Indent the credit, delivery revenue $1,200 with the source document receipt 2. Hopefully you feel comfortable with this. And I'm going to encourage you to now move on and start completing the assignments as they're outlined in Moodle. Use the video, use your book, use your friends, use your instructor to help you understand the material. Good luck.